The deal I'm going to present to you guys today is a hotel to apartment conversion in Denver. And I learned this strategy at PEG. Like Cam said, they have a fund just for these types of conversions. I think they've done 25 of them or so. This is a co-GP between my group, Elkstone Capital, Hotel Shift, and Voyage Capital. So a little bit of background on me real quick. After getting out of school, I went and worked for Property Reserve, which is the for-profit real estate arm for the Church of Jesus Christ of Latter-day Saints. So I was there for a couple years. I was the senior analyst, so I would underwrite all their ground-up development projects. So while I was there, we deployed about $500 million into warehouse and logistics centers, build-for-rent communities, and then mixed-use multifamily. And then I started Elkstone about 2 years ago. I've been pretty fortunate to do well in a tough market. I've been able to raise about $17 million in equity over the last 2 years for various projects. We're up to 612 doors. This will push us close to 1,000. So the general partner team combined experience, $235 million in assets under management, 40 plus years of combined experience, 22 properties currently under management, and a full cycle IRR of 27%. So I do multifamily and then I do these conversions. Hotel Shifts, they specifically do hotel to apartment conversions. Voyage specifically does hotels. I'll explain later why they're involved. So a quick case study. Imagine you've got two buildings. They look exactly the same. They're built exactly the same down to the granular level, and they make the same net income. Which building is worth more? So it depends. Depends on what the asset type is, right? So let's say the one on the right is an apartment and the one on the left is a hotel. Still the same exact building making the same income. Now, which one do you think is worth more? Exactly. And so all commercial real estate is valued on the income method. They use what's called a cap rate. So Cam kind of got into this. This is a more simplified version, but NOI, so the income of your property divided by purchase price, gets you to the cap rate. So if I have a property that's generating 100 grand a year, I buy it for $1 million, I bought it for a 10% cap rate. And then the inverse, you can take your NOI divided by a cap rate to get to what your purchase price is. So the reason the hotel to apartment conversion strategy is so powerful is because look at this red line up top. So that is cap rates for hotels across the nation. And then the yellow line is multifamily. So there's a large divergence. Now, let's say the building on the left, let's use $1 million as an example. Let's say you can buy that at an 11% cap rate because it's a hotel. It's worth $9 million. Same exact building, but it's an apartment. We'll trade at a 6 cap, so a lower cap rate. That one's worth 16.6. And so that's the power of conversions. We look for hotels. Typically they're Class C, they're older. Sellers are very motivated to sell them because they don't pencil as a hotel. So we're buying in the 40 to 70K a key per door range. And then we get in, we literally change the use to multifamily, and then it's just worth so much more once it's stabilized. Typically, we're able to cash out refinance close to 100% of our investors' initial contributions. And Cam talked about this a little bit, but it's really expensive to build ground up right now. It's really hard to make deals pencil. So a lot of these hotels have good bones. They were already designed for living. So it's much cheaper to buy them. We target extended stay brands that already have kitchenettes. The deal I'm going to show you today doesn't, so we actually have to install the kitchenettes in all the units. Let's see, so why multifamily first of all? Again, Class C, our goal is to always be the best bang for your buck product in the market where we're doing these conversions. We literally want to be the cheapest and best value. So you could say this is in the affordable housing sector. Our rents are always on the very low end and that helps lease up these conversions. And then Class C buildings historically are the least economical to build. They historically have experienced very low vacancy, whether the market's good or bad. Everybody always needs Class C housing. Cam also covered this. There's 4 to 5 million households in America, or we're short 4 to 5 million households in the affordable range in America. And then why hotels? Again, designed for living. They're typically in great locations with a lot of traffic, and we can buy them really cheap right now. So just a couple of our standards, we don't take entitlement risk. So typically when you convert a hotel to an apartment, a lot of the times you have to change the zoning. So that's the first thing we always do. We always call the city and ask if they will entertain changing the zoning. If they won't, then we move on to the next deal immediately. We only do hotels to multifamily. Cam mentioned you can do office to multifamily conversions. I was talking to David tonight. He showed me somebody who had done a hotel to self-storage conversion, which is super interesting. We just focus on hotel to multifamily. And then, like I said, we want to be the best priced product in the market. So this is the deal. This is an 11-story hotel in Denver, Colorado. It was built in 1971. A large asset manager out of New York owns it, named Monarch. They have a debt fund, and they actually picked this up in a foreclosure a couple years back, and it's just not making money. Despite a top line revenue of $6 million a year, they still cannot break even. So they've been trying to sell it, and we've been negotiating with them all year. Originally, we had it under LOI at $35,000 a door, and then we went back and squeezed them a little harder, and we got them down to $29,000 a door. So there's 309 units. Our all-in cost of this project is $23 million. Our purchase price itself is $9 million. So we're actually putting $10 million into this building. Add on our interest reserves, insurance, tax, fees, and that's how we get to that all-in cost of 23. We will hold this for 10 years. I'll explain that on the next slide, and we're raising $6.2 million to do this deal. So this is the area. This is on Quebec Street. Downtown Denver is about 18 minutes to the west. The airport's 16 minutes to the northeast. And as you can see, there's a lot of great retail in the area. We're that property in the red square. Right across the street, United has their flight training center. There's a Sam's Club you can see in the bottom right, a Walmart. So it's a fantastic location. And if you look in the bottom right bubble, this isn't an opportunity zone. So opportunity zones are super cool because you can come into our deal via 1031 exchange or selling stock, and within 180 days, if you invest into our deal, and we hold the asset for 10 years, then all your capital gains are eliminated permanently. There's a couple of things we have to do for that. Our improvements into the property have to be equal or greater than our basis, which they are. Our improvements are 10 million, we're buying it for 9. And then Denver, workforce housing is very needed right now. There's about 100,000 households short in the affordable rent range. And 50% of all renters in Denver are cost burdened, which means they're paying more than 30% of their median income. So we're targeting a 23% IRR to LPs on this deal. We anticipate being able to sell this for $40 million in 2036. And then in the middle, cap rate compression. Cam talked about the developer spread. Developers need 2.5% to justify taking the risk of a development. So if you looked at the multifamily income of this deal, once it's stabilized relative to our price, we're buying it for an 11.2% cap rate. And right now, Class B in Denver is trading at high fives. So we're pretty confident we can exit at a 6.5 cap, and that's how we come up with that $40 million exit valuation. So this is the interior of the property. You can look at that middle picture. That's what the units look like. So they're nice. We're gonna tear out the carpet, put in new flooring. You'll notice there's no kitchens, so we are doing kitchenettes on all of these. Every unit has a balcony. You can see that in the bottom left. You can see this is a tower, so it's got a big central area. There's a restaurant, there's 2 racquetball courts, there's an indoor and outdoor pool, and we will be adding a dog lounge, a golf simulator, and we will be extending their fitness facility. So here's the business plan. Month 0 to 2, we're gonna demo a lot. We're actually gonna knock out 69 units because right now they're all studios, all 309. So we're gonna end up with 240, some of which will be studios, some will be 1-beds. Months 3 through 9, we'll be doing the cabinets and flooring and the kitchenettes. I'm gonna skip forward so you can see what this looks like. So this is our kitchenette scheme. So stainless steel appliances, they'll have a 4-burner stove, cabinets, everything they need to live comfortably. All the units already have fire sprinklers in them. That's one of our CapEx projects, is we actually have to install them in the corridors. They have them in the units, but not the hallways. Months 10 to 12, finish the fire suppression system, start leasing. Months 13 to 28, lease until we hit 90% occupancy. We think we can lease up 15 units per month. And then month 29, refinance. And based on our pro forma, we're targeting nearly 100% cash out refinance at month 30. And that is, cash out proceeds are non-taxable. And then months 30 and beyond, hold the property until 10 years to get our opportunity zone benefit. So Denver Post has already picked up our deal. We submitted our package to the city and the journalist picked it up, so that's pretty cool. Same with the Denver Business Journal. There's a cool video on Instagram. If you look up Developing Denver, you can see our project. We're working with an architect they strictly do hotel to apartment conversions. A couple more pictures. Let's see, oh, by the way, the bathrooms are all brand new. They did a PIP in 2021, so they put several $1 million into the project. More interior photos. Here's a view from the balcony. You can see downtown Denver. Here's some of the public areas. This is a view looking down from inside the building from one of the higher floors. Conference rooms. Here's the fitness center we'll be extending, and then the pools. So just a couple of our return metrics. So I've pretty much covered everything on the left. On the right, our refinance value will be about 30 million, pulling out just shy of 6 million. Again, targeting a 23% IRR to our LPs, which works out to about a 3.5x equity multiple. So you put in 100 grand over 10 years, you get back 350 grand, and you don't pay taxes on any of it. We'll be getting a bridge loan on this. We've already engaged a regional bank that we're trading terms with. It's got some interesting stats. We're underwriting to a 47% OPEX ratio, which we feel is fairly conservative. That we will do a cost segregation, of course, so our investors will get bonus depreciation. And then there's our rent. So I think that's important to pay attention to. So we're pricing our studios at $1,150 and our one beds at $1,400. I'll tell you why that matters, and then I'll come back to this. So per Zillow, the average rent for a studio apartment in Denver is $1,245. Again, we're at that $1,150 mark, so we're well under that. And then we're right in line with the two beds, which is $1,400 a month. I won't get more into the financials. As far as our fee structure, we're taking a 3% acquisition fee, a flat $5,000 a month asset management fee, and then at year 10, we'll take a disposition fee when we sell. And then why Denver? We like Denver because it's had in Colorado, because it's had continuous population growth. It's got a thriving job market, supportive regulatory environment, and then the housing shortages. I already mentioned these stats, but we're confident that these are gonna fly off the shelves at this price point. And then I love this picture. You can see there, Denver in 2000, Denver in 2019. So it's a large MSA, it's gonna keep growing. And the old adage of real estate is location, location, location. So why invest with us? One reason I wanna share is on Tuesday, we sent our earnest money deposit in, and it's hard. So from day one, my partner put up 500 grand, which comes out to about 8% of the 6.2 million. And it's already hard, so we have to perform or we lose that $500,000. So we have substantial skin in the game. Here's the team. So Alex Cartwright runs the ship. Wen and Jeff work with him. Jeff is our loan guarantor. Amy is the person who's designing the building, the architect. Got myself, and then Jai and Siraj are our hotel partners. I forgot to mention this. When we close on the property, we'll convert half the building all at once, and the other half will actually continue to run as a hotel, an America's Best Value Inn, while we're doing the conversion. And then once we're done with the first half of the units, we'll take that flag back down and we'll convert the rest. And then Jana Farrow, we're gonna use Asset Living. They're a large national property management company to manage this. So it's a 506C investment, so accredited investors only. There's a lot of different ways you can invest, as you see there in the bottom left. Minimum investment is $100,000. I think my biggest ask on this deal is opportunity zone investments like this are pretty coveted. So if you know anybody who's recently had a large exit, they've sold a company or they've sold real estate, it's not uncommon for investors like that to want to take that whole equity stack and put up a $5 million check. So I think that's what we're looking for.